Hi everyone, let's go over my bearish Elliott Wave scenarios on Bitcoin, and for the bullish scenarios check the previous video, where in this particular scenario on the high time frame we are looking for an expanding flat scenario with 3 waves in A, 3 waves in B, and then a 5-wave structure to the downside in wave C. The most common target area for a wave B in an expanding flat is between the 1.236 and the 1.38. As you can see, we are currently ranging above the 1.38, so above the common target area for a wave B, but still inside the target area for a wave B, because the 1.618 is a less common target, but a target nonetheless, which is sitting at 36.2k. So as long as price is not closing high time frame candles above the 1.618, above 36.2k, this scenario is still very much alive and has probabilities for then a 5-wave structure to the downside in a wave C, where you're then going to be looking for the target between the two 1.618s, which is between 24.7k and 18k, which also means you're going to take the double bottom that we have over here, low 1, low 2, and very likely fill the Bybit wick to 23.6k. You can imagine that also if price is moving to the downside, that we are going to move to at least 23k, if not also 21.9k, reason being this volume profile of this range over here. We tested the value area high twice for support. Third time of asking, high probability, it's going to fill. We're going to move to 23k or then 21.9k, which as you can see is also nicely positioned inside this wave C target area. Now that means that wave B then has to be a 3-wave structure, because as mentioned, we're looking for a 335. So if we then zoom in to this wave B, go to the 12-hour chart, then in this particular scenario, we have to look for an A, B, C to the upside, which preferably in this scenario is finished, but I'll get to this in a second. So wave A is then a 5-wave structure in an expanding diagonal, which is rare, absolutely not common. Then wave B hit the 0.382 taken from the low to the high, which is a common target for a wave B, so that is okay. But then we get this wave C to the upside, and this is where we encounter some problems, because we then have a 1, 2, that's okay, 3, that's fine, 4 and 5. Preferably you want to have wave 5 ending over here, and that is because of what we see on the lower time frames, which I will show in a second. Because if we are looking for a bigger wave C to the downside in the high time frame A, B, and then a C, well, this wave C to the downside is an impulse 1, 2, 3, 4, 5, which means that inside wave 1 you also want to see lower degree impulsive structures to the downside, and that is a challenge at the moment, which increases the probabilities you're at least going to take this high once more at a certain moment in time, which then also means that whatever is going to happen over here still has to be part of the blue wave 4, which then means this blue wave 4 over here is going to be very, very long in time compared to this very, very small wave 2 over here. Now, the rule of alternation says that if wave 2 is very short, wave 4 can be long. That's absolutely true, but there is still a time relationship between the two. Most commonly, wave 4 ends before the 3 or 4 Fib time of wave 2, meaning wave 4 usually is not longer than 3 to 4 times the length in time of wave 2, which kind of is already the case. But of course, if we're going to range for an even longer period of time, we're going to get a problem, lowering the probabilities that this is going to be a wave 4, 5, and then a big dump to the downside, which increases probabilities for continuation in the bullish scenarios mentioned in the previous video. So this is then something to still look for, but after hitting the 1.618, also still a target for C, sitting at 36.4k, you then want to see a move towards the downside impulsively, and also preferably you want to see big bearish CVDs over here locally, that if you get a move down, retracement to the upside, big bearish CVD divergences, you can see then that there's absorption of market longs for then a push down to lower prices. Now if we then go to this high and we zoom in to the lower time frames, I will explain to you the reason why the probabilities are higher to still take this high over here. So first of all, we have the triple 1, 2, 1, 2, 1, 2, 1, 2, eventually a move to the downside in a big wave 3. That is the expectation. Now, most commonly, a triple 1, 2 or a double 1, 2 has a structure like this, where each next wave 1 and each next wave 2, and then over here 1, 2, 1, 2, and then the next 1, 2, and then eventually down. Each next wave 1 is most commonly shorter in time and price than the previous wave 1. Same with the wave 2s as well over here. Usually the second wave 2 is shorter in time and price than the first wave 2. That is most common, creating a bit of a diagonal structure. But that is also the problem over here, because the second wave 1, which is a lower degree wave 1, as the green count is the highest degree Elliott wave count, 1, 2, 3, 4, 5. Inside the green 3 we have blue, 1, 2, 3, 4, 5 in blue, and then inside the blue 3 we have the white count, 1, 2, 3, 4, 5. But you can see the ratios of the different degrees are not really what you want to see. The second wave 1 is longer in price and time compared to the first wave 1, even though the green one is a higher degree wave 1. The third wave 1 in white is much longer in time compared to the previous higher degrees wave 1, the green and the blue one, which is not what you want to see. Now this wave 2 is fine. The problem here is this wave 2. This wave 2 in white is much longer at the moment than any of the higher degree wave 2s, which just doesn't work. So of course the official invalidation would be taking this high over here, but based on the ratio of the different waves and the degrees, there's very low probabilities this is some sort of a 1112. And also we did not see strong absorption of market longs on CVD. There's no strong bearish CVD divergences between, for example, the high and the lower high, or the lower highs over here, or between this two and what we see over here, which also lowers the probabilities. Now then, if we look at more like a regular impulsive structure, so let's say a 1, 2, 3, 4, 5, you don't want to see overlap between the low of 1 and the high of 4. 1, 2, 3, 4, 5. Eventually, you can see 4 and 1 have overlap, and that invalidates an impulsive structure. That is not what you want to see. So, and besides, by the way, also wave 4 retraced to the golden pocket, which is incredibly rare for a wave 4. Usually, if it hits the 0.618 taken from the high of 2 to the low of 3, for me it's an invalidation. I always use it as an invalidation, but also the fact you have overlap really reduces probabilities for this scenario. In my opinion, it's just invalidated really. And then because we have overlap, you then have to think about diagonals as well. Overlap between 1 and 4 is something you want to see in a diagonal, 1, 2, 3, 4, 5. But the problem here is that wave 3 is longer than wave 1. That is not a problem per se, because then you think about an expanding diagonal. Now, an expanding diagonal is rare, right? It's not common at all. But then you also want wave 5 to be longer than wave 3. But the problem is wave 5 is not longer than wave 3. Because if you take a trend-based fib from the high of 2, low of 3 to the high of 4, toggle on the 1 to 1 fib over here, you can see that this move is shorter in price than wave 3. But wave 3 is longer in price than wave 1. And therefore also a diagonal is invalidated, which eventually means that the low you have here has a high probability of being a corrective low in either a wave B or a wave X of some sort, and this being a 3-wave structure. But that then also means that if this is a corrective structure to the downside, probabilities are much higher. You're going to take this high. The high is not yet in for a high time frame wave B, right? For then a very big wave C to the lower 20s, meaning you probably, by far highest probability, gonna see this high taken at least once more. Yes, price can move to the downside, absolutely. There's good reasons to do so, which I will show over here, right? There's a lot of liquidity over here, many lows that price can take. We can even go down all the way to 31.6, absolutely no problem. The probabilities do not change, because also with the bullish video that I made previously, it's very normal for price to actually go to this area over here because of the very high time frame value area low that we have and can potentially retest at 31.3, as well as the very big support resistance area over here on the weekly time frame, which we also have. So there's, you know, enough support in this area as well. But as long as price is moving down, probabilities remain higher to go up, because you can't really count a bearish impulsive scenario to the downside over here. Now you can see we have a triple bottom 1, 2, 3. We also have a double bottom on the chart, which are the two lows here, and if it continues we have even more liquidity. So there's a lot of liquidity to the downside, which of course is very interesting. If we look at these CVD divergences, then the divergences played out as mentioned this morning. We had bullish CVD divergences, price pushing to the upside, taking this high. That was the target of this bullish CVD divergence. The target of this one over here was the lower high, which also has been taken. So these have played out, and currently we are in a neutral playing field. And if we then look at the probabilities of the different scenario, then as mentioned, the probabilities are higher that this is also called like a fake low. So not a wave 5, but a corrective low. which then increases the probabilities. Price will at least take this high once more, at least once more, both in the bullish and the bearish scenario. But at the moment, looking at this structure as well, three-wave structure, if this is a fake low, a corrective low, then probabilities are higher. You will eventually come down once more. First, then also take the liquidity before you make a potential wave 5. Even if you take the high now and potentially then an ABC flat, the probabilities are still higher. You're going to take these lows, you're going to move to the downside before you get a true move to the upside for a potential wave 5 or continuation in the bullish market. So in general, zooming out, probabilities, yes, price can move to the upside, by the way, locally. We have some resistance over here, just to give you this info, 35.2 to 35.4, right? Interesting area of resistance, bit of support here, 34.3, 34.5. Also here, 33.8, 33.9. So that's all good, all nice. We can move to the upside, to that resistance area, but in general, even if we would move higher and take this high, probabilities are higher to take the lows before you get a real move to the upside to end a bigger wave B on the higher bearish time frame and move down, or continuation for the bullish scenario shared in the previous video. I hope this video was helpful or valuable to you. Please check out the most recent educational video I've made about the best trading indicator you can use, in my opinion, which is the CVD. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.